Let me welcome you to my presentation. Today, I'm delighted to present to you one of the most important accounting standards, and that is International Accounting Standard number 21, Effects of Changes in Foreign Exchange Rates. One of the standard that is used by companies that are trading across different countries that are buying, say, materials from outside the country of origin and are using a foreign currency. So we are going to give you a refresh of how those transactions are accounted for. And there are also times when a company would have an operation in a foreign land. Let's say a subsidiary, a company that's got an origin in Malawi, might have a subsidiary in the United Kingdom, where the transaction that are accounted in the United Kingdom, like the British pound, is different to that of Malawi, that is Malawi kwacha. When such things happen, how do we account for foreign operation and foreign transactions? International Accounting Standard number 21 addresses that fact. Below, I'm displaying my contacts. I'm a part-time online lecturer. Should you require my services, or you or your loved ones require my services, do not hesitate to contact me, and we are going to have a date. Remember, you have to pass on first attempt. It's easier to pass on first attempt, and it's cheaper if you pass on first attempt. Strategic business reporting students and F7 students or accounting students in, if you're pursuing your Bachelor of Accounting degree or auditing, this is your time to understand this standard. All right. Let's dive into our discussion. So we are saying that an entity can enter into foreign denominated activities in one of the two ways, as I alluded earlier, by entering into a foreign currency transaction directly. In such a case, the foreign currency transactions need to be converted to functional currency of an entity. So the functional currency is a currency at which the primary economic activities occur. Okay, the functional currency. I've put a slide where I'm discussing this in detail of facts. The company can also have a way by conducting its foreign activities through a foreign operation. For example, a company can have a subsidiary, an associate, or joint arrangement, or a branch of the reporting entity in a country other than the country of origin. A South African company that has got its origin in South Africa can also have a subsidiary or a related party in other countries, Russia, Botswana, Zambia, and so on and so forth. In such a case, the foreign operation will keep accounting records in its own functional currency, which, if the currency is different from the presentation currency of the reporting entity, the reporting entity must translate the transactions into a presentation currency. I hope it makes sense. In simplest terms, what I was saying is that suppose that a Malawian origin company, which has a functional currency, the Malawi kwacha, has got a subsidiary in Mozambique, of which in Mozambique they trade using Metcash. So your transactions that are in Metcash should be translated into Malay Kwacha. Thereby, you will use an exchange rate between these two currencies. So there's a point to note. The presentation currency, the function currency, these two might be different. Okay? So the keywords that we need to be aware of, number one, the foreign currency. The currency other than the function currency of the entity. Foreign currency. Number two, functional currency. The currency of the primary economic environment in which the entity operates. Functional currency. Number three, presentation currency. The currency in which the financial statements are presented. Number four, an exchange rate. The ratio of exchange for two currencies. Exchange rate. Number five, exchange difference. The difference resulting from translating a given number of units of one currency into another currency at different exchange rates. Exchange difference. An exchange difference may arise in such a case where the date of a transaction, the rate at which was used at the date of transaction is different, is higher or lower than the rate at which the transaction is being settled. An example, a Malawian company purchasing materials in China using US dollars. Let's say at the time when the transaction occurred, the rate of the US dollar to Malay Kwacha was 1,200. Now, the date of payment, you'll find out that the exchange rate has gone up to 1,500. The difference between 1,500 and 1,200, which is 300 kwacha per unit per dollar, it's an exchange difference. We are going to see how is that accounted for. Students that are pursuing SCCA, strategic business advanced, sorry, it's called strategic business reporting, SBR. You must understand how transactions are translated, because you might be given a parent company with a subsidiary in a foreign denominated account, or you can be given a transaction with a foreign operation. Let's say consolidation in foreign operation. How do you account for such? It's quite important that you should be well aware of what exchange rate you should use. It's a closing rate, it's a spot rate, it's an average rate. Okay. You're accounting for goodwill and so on and so forth, impairment and so on and so forth. Which rate are you going to use? We are going to see how that is done. Right. Another keyword is a closing rate, the spot exchange rate at the year-end date, the closing rate. Another keyword, spot exchange rate, the exchange rate for immediate delivery, spot exchange rate. Another keyword is monetary items, and that is units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency. We're also going to see what are non-monetary items and what are monetary items. Which rate should we use to translate monetary and non-monetary items? Quite important. Transaction date, the date of transaction. That is the date on which the transaction first qualifies for recognition in terms of the accounting standards. Okay, let's dive into functional currency. What is functional currency? To repeat what we said, a functional currency is defined as the currency of the primary economic activities in which an entity operates. Okay, an example has already been given. So an entity does not have a free choice of functional currency. That is to say that an entity has to determine its functional currency by applying the principles prescribed in International Accounting Standard number 21. There are rules and regulations that you need to use as per IAS 21 in how to determine a functional currency. Okay, the primary indicators that are linked to the primary economic environment of the entity, while there are also secondary indicators that are provided as an additional supporting evidence to determine an entity's functional currency. So what you're trying to say is if the primary activities are not sufficient to substantiate the functional currency, you should use the secondary activities. But the key is to check if the primary indicators are there. In absence of insufficient primary indicators, jump in and check the secondary indicators to support the evidence on how you determine the functional currency. It is evident from the primary indicators that an entity's functional currency is there. So in absence of the primary indicators, you can check the secondary factors to determine the functional currency. So factors considered in determining the functional currency, we start with the primary indicators. Number one, the currency that mainly influences sales prices for goods or services. Normally, the currency in which the sales price of the goods or services is denominated and settled. That currency can be a functional currency. So you look at the currency at which a company is using to sell or to charge its sales. Which currency? You are in Malawi, you're operating your business in Malawi. By law, you need to charge your goods and services you're offering in Malawi kwacha. But there are times when conditions apply where you charge your activities in dollars, or your activities are tagged to a dollar, the movement of a dollar, or the movement of the pound, whichever the case. So we are saying, first of all, look at the currency in which the company is influenced to charge its goods and services. Number two, the currency of the country whose competitive forces and the regulations mainly determine the sales price of goods and services. I repeat, the currency of the country whose competitive forces, regulations mainly determine the sales price. Condition number two. Okay, condition number three, the currency that mainly influences labor, materials, and other costs of providing goods or services. Normally, the currency in which such costs are denominated and settled. Okay. Number one, sales, the currency at which influences how you charge your sales. Number two, check your competition. What are they charging? Number three, check how are you paying your labor, your main cost labor, materials, and all, so on and so forth. Which currency are you using to buy your materials, your labor? Okay. Those are the primary activities. Secondary activities. We're saying the currency in which funds from financing activities, such as issuing debt and equity instruments, are generated, and the currency in which receipts from the operating activities are usually returned. When you make a sale, how do you return your receipt, the money that you get? In what currency do you retain that money? How are you getting the finance to move the operations of the business for such an operation? Okay. Three, what we're saying that in certain instances, determining the functional currency of an entity may be straightforward, given the conditions and the facts in the case. Okay? While in other instances, judgment may be required to determine the functional currency that most faithfully represent the economic effects of underlying transactions, events, and conditions. So there are other instances. An examiner will give you other instances where you need to apply your mind, your judgment, depending on the given facts. Okay? So what I'm saying is that in SBR exam, the examiner will give a case in which some or all the factors are available. It is as simple as applying the rules given in this presentation in order for you to determine the functional currency. In cases where primary factors are not sufficient, it is imperative, it is very important to use secondary factors in order to substantiate your assumptions for a given answer. So the examiner will check your evidence provided in a given case and award you marks based on the facts that you've given. So you gotta defend your assumptions. Your assumptions should have evidence according to the given case in a scenario. Okay, so let's dive into looking into monetary and non-monetary items. So what are monetary items? Monetary items is defined as units of currency held and assets and liabilities to be received or paid in a fixed or determinable number of units of currency. Monetary items. Okay? The essential feature being a right to receive or an obligation to deliver a fixed or determinable number of units of currency. All other assets and liabilities are monetary items. In the balance sheet, in the statement of financial position, the assets, the liabilities are monetary items. So what rate are you going to use translating monetary items? Very important. Okay. The essential feature in this case is the absence of a right to use. Okay. To continue, the following are examples of monetary and non-monetary items. I've given examples of monetary items to my left and non-monetary items to my right. So examples of monetary items: pensions and other employee benefits to be paid in cash, monetary item. Provisions that are to be settled in cash, monetary item. There's an attachment to money. Lease liability, monetary items. Cash dividends that are recognized as liability, monetary items. A contract to receive or deliver a variable number of entities on equity instruments in which the fair value to be received or delivered equals a fixed number of units of currency, monetary items. Non-monetary items, examples: amounts prepaid for goods or services, prepayment, non-monetary item. Goodwill, non-monetary items. Intangible assets, non-monetary items. Inventory, non-monetary items. Property, plant, and equipment, non-monetary items. A right of use of an asset as prescribed in IFRS 16, non-monetary items. Provisions that are to be settled by the delivery of a non-monetary asset. It's a non-monetary transaction, which is non-monetary items. Okay. Now, IAS 21 requires each individual entity within a group of companies to determine its functional currency and measure its results and financial position in that currency. When a company has got a foreign operation, I said earlier to say a Malawian origin company having an operation in Botswana, the company that is in Botswana may be trading in Pula, Botswana Pula. Okay. So a Malawian origin company, for it to report its financial operations, it has to translate transaction that is of the foreign operation in Botswana into Malawi kwacha. Okay. However, the company might choose which currency should be its functional currency, where it's operating. Okay. So the determination of each entity's functional currency must be performed on a standalone basis, as the group does not have a functional currency. Okay. So an entity may present its financial statements in any currency. For example, when a group consists of individual entities with different functional currencies, the results and financial position of each entity are expressed in common currency called the presentation currency of the parent company. So what you're saying is that in consolidating the financial statements, the currency that is used is a presentation currency. Whatever currency is being used as a functional currency wherever the company is performing, to bring back the transaction into the country of origin, we use the presentation currency. So terms and conditions apply for you to choose the presentation currency. So the translation of financial statements of foreign operation with a functional currency that differs from that of the reporting entity takes place directly into the currency in which the financial statement, that is consolidated or separate, in the case of a branch or subsidiary of the reporting entity, are presented. Okay. Let's look at the foreign currency transactions. There are two types of foreign currency transaction. That is conversion and translation. In terms of conversion, it's a process of exchanging amounts of the foreign currency for another currency. For example, suppose a US company buys a consignment of goods from a supplier in Germany. The order is placed on 1 May and at the agreed price of 124,250 euros. At the time of delivery, the rate of foreign exchange was €2 to $1. The logo company would record the amount owed in its books as follows. So looking at the exchange rate at the time when the transaction occurred, 124,250 euros. €2 is equal to $1. What it means is that the dollar is more powerful than the euro, because $1 is buying you €2. So if you take 124,250 divided by 2, we'll find the amount in dollars. Okay. And that is, we're going to debit purchases, 124,250 divided by 2, because €2 makes $1. And that will give us $62,125. The credit entry will go to payables because we purchased this on credit. The company purchased the materials on credit from a German supplier. Okay. So when the US company comes to pay the supplier, it needs to obtain some foreign currency. So by this time, however, if the rate of exchange has altered to 2.05 euro to $1, the cost of raising 124,250 would be $60,610. It's gonna go down because the rate increased. Okay, that is $1 is buying, the $1 now is buying 2.05 euros. The dollar has gained. Okay, So if you take 124 divided by 124,250 divided by 2.05, it's going to give us 60,610. The difference being 1,515. That is a profit recorded on conversion. Foreign exchange differences, quite important. Okay, so the transaction would be to debit payables 62,125 and credit cash 610 and credit profit on conversion 1,515. Why are we debiting payables? Because we've settled, the company has settled. Remember, payables are a credit entry. So debiting shall mean settlement. Okay, the corresponding entry of a settlement is 60,610, which is cash, and the profit realized is 1,550. That is very simple. Okay, another one is translation. We are saying that a foreign currency translation, as a distinct from conversion, does not involve the act of exchanging one currency for another. But what does it involve? The translation is required at the end of the accounting period when a company still holds assets or liabilities in its statement of financial position, which were obtained or incurred in foreign currency. Translation. So each year end, a company should translate the non-monetary items, in short. Okay? These assets or liabilities might consist of one, an individual home company holding individual assets or liabilities originating in foreign currency due, a Malawian company holding individual assets or liabilities originating in foreign currency due, let's say foreign operation in Zambia, foreign operation in South Africa, foreign operation in Mozambique, but it's a Malawian origin company. If the parent company is originated in Malawi, it has to translate all those transactions into the home currency, the presentation currency. Okay. Number two, an individual home company with a separate branch of the business operating abroad, as I put it, which keeps its own books of account in the local currency, wherever it's operating. So let's say that an example that a Beijing subsidiary purchases a piece of property at 2,100,000 euros on 31 December 2027. The rate of exchange at this time was 70 euro to $1 at the time when the property was purchased. During 20X8, the subsidiary charged depreciation on the building for 16,800 euros, so that at 31st December 20X8, the subsidiary recorded the following transactions. Number one, property at cost, that is 2,100,000, which is here. And number two, we have to remove the depreciation at year end for 16,800, that is here, remaining with a carrying amount of 2,083,200 euro. Okay, at this date, the rate of exchange has changed to 60 euros to $1. What does it mean? It was 70, now it's 60. It means that the dollar has lost its value by 10 euro to $1. Okay, because less euros is buying $1. Yeah, that's what it means. So the local holding company must translate the asset value into dollar, but there is a choice of exchange rates that need to happen. So should the exchange rate of translation be the rate which existed at the date of purchase, which would give a carrying amount of 2,083,200 euros, divided by the 70. That's the rate at which was used at the time of the transaction. It's gonna be $29,760. Should the rate of exchange for translating be the rate existing at the end of 20x8, the closing rate of 60 euro to $1, this would give a rise to $34,720. We take 2,083,200 divided by 60, is gonna give us more dollars. Okay, so here it means that the dollar gained by 10 euro. Yeah, because taking the same amount dividing by 60 is giving us more dollars. Yeah. So I revert my area announcement where I said the dollar lost the value, but in this case the dollar gained the value because we're moving from euro to dollar. So more dollars are needed. Okay. So similarly, should depreciation be charged to group or profit or loss, the exchange rate of 70, that is the historical rate, would be, and 60 to $1 on the closing rate, or the average rate, say 64, just to take 70 plus 60 divided by 2. So what will be the choice? The standard says non-monetary items should be translated at closing rate. There's no discussion on that. So the correct answer here, the closing rate is 60. So 34,720. The difference between 34,720 and 29,760 is exchange difference. Again, there's a gain element there. Okay. So IAS 21 states that foreign currency transactions should be recorded on initial recognition in the functional currency by applying the exchange rate between the reporting currency and the foreign currency at the date of the transaction to the foreign currency amount, as we saw earlier. So an average rate for a period may be used if exchange rates do not fluctuate significantly. And I must also say that the income statement transaction are exchanged at an average rate. That is the principle. So the following rules apply at each subsequent year end. Reporting foreign currency monetary items using the closing rate, as I alluded earlier. Reporting non-monetary items, non-current assets inventory, which are carried at historical cost in foreign currency using the exchange rate at the date of the transaction, historical rate. I revert my statement area that we should use the closing rate. Actually, we use the historical rate. That is the correct rate. Okay. Reporting non-monetary items which are carried at fair value in foreign currency using the exchange rate that exists when the values were measured. Non-monetary items carried at fair value in foreign currency, we must use exchange rates that existed when the values were measured at the date of measurement. Okay. Now, how do we recognize exchange differences? The exchange differences occurs when there is change in the exchange rate. That is a given fact. The difference should be between the transaction date and the date of settlement of the monetary items arising from the foreign currency transactions. Exchange differences arising on the settlement of monetary items. Monetary items could be receivables, payables, loans, cash in foreign currency, etc., or on translating the entity's monetary items at rates different to those at which they were translated initially or reported in previous financial statements should be recognized in profit or loss in the period in which they arise. Keyword is monetary items translated. The differences in exchange difference on monetary items should be reported in the profit or loss. It's a rule in the standard that must be followed. Okay. There are two situations to consider. Number one, the transaction is settled in the same period as that in which it occurred. All the exchange differences is recognized in the period in which the transaction occurred. B, the transaction is settled in subsequent accounting period, okay, year after when the transaction occurred. The exchange difference recognized in each intervening period up to the period of settlement is determined by the change in the exchange rates during that period. Quite important. So in other words, what I'm trying to say is that where a monetary item has not been settled at the end of the period, it should be retranslated or restated using the closing exchange rate and any gain or loss taken to profit or loss. Okay? Very important. An example. Cito company, whose year end is 31st December, buys some goods from Telomere, South Africa, Telomere SA of France on 30th September. The invoice value at the date of transaction was 60,000 euros and is due for settlement in equal installment on 30th November and 31st January. The exchange rate moved as follows. On 30th September, $1 was buying 1.6 euros. 30th November, $1 was buying 1.8 euros. 31st December, $1 was buying 1.9 euros. And 31st January, $1 was buying 1.85. So the dates and the rates are quite important when you're calculating, when we're translating transactions, or when you're calculating foreign exchange differences. So, required, state the accounting entries in the books of Cito company. Given this fact, what should we do? What should we do? Remember, transaction occurred on 30 September when the rate was 1.6. So if we take 60,000 divided by 1.6, how much will be the value of the goods? Then we'll look at 30 November when the rate was 1.8. If we take 60,000 euros divided by 1.8, what will the rate be? So any exchange differences, we should account for them and account properly to make sure that all foreign exchange differences are accounted for properly and accurately. So what you should note here is that there is 60,000 euro. Okay. And the dates are 30 November and 31st January. Where 31st January, the rate is 1.8, and 30 November, the rate is 1.85 for 31st January, and 30th November is 1.8. So at 30th September, we're gonna say 60 thousand euros divided by 1.6. Okay. So I've provided a solution here. What we're saying is that, let me push this back a bit. What we're saying is that the purchase will be recorded in books of Ciro company using the rate of exchange ruling at 30th September. That is 1.6. Okay. So if we take 60,000 euro divided by 1.6, is going to give us 37,500. We're going to debit purchases, 37,500. And we're going to credit payables, same amount. Okay. And that is the rate, 1.6. So on 30th November, Cito company must pay 30,000 euros, like half of the 60,000. This will cost 16,667. If we take 30 divided by 1.8, this is this rate at 30th November. Okay, 16,667. And the company has therefore made an exchange gain of 2,083, sorry, 18,760. It was supposed to pay 18,760, but it paid 16,667. Where is 18,760 coming from? We take 30,000 euros divided by 1.6. That is 18,750. But the rate moved to 1.8. It means less dollars to be paid. A gain in the dollar. Okay. The gain is by 2,083. Now, what are we going to do? We debit payables 18,750 to remove the total amount that was owing by that time. And we credit exchange gains profit, that is 2,083. And we also credit cash 16,667. Okay, cash received. On 31st December, that is the year end, the outstanding liability will be recalculated using the rate applicable on that date. That is the 30,000 euros will be translated at 1.9, the rate at 31st December. Okay, that is 15,789. A further exchange gain of 2,961. Okay, where is it coming from? All right, we'll see. So what will be the accounting transaction? We're going to debit trade payables at 2,961. And we're going to credit exchange gain, 2,961. The total exchange gain, now it's 5,044. That is 2,083 plus 2,961. Okay. At that date, the company was supposed to pay 16,216. But it paid how much? It paid 15,789, leaving a gain of 2,961. Okay. So we're going to account the transaction. We're going to debit payables 15,789, knowing that we've already debited 2,961 to remove the total amount owing, leaving a loss of 427. That is the difference between 16,216 and 15,789. Okay, we're gonna credit cash 16,216. Okay. So when a gain or loss on non-monetary items is recognized in other comprehensive income, for example, where property is revalued, any related exchange differences should also be recognized in other comprehensive income. And that is the end. For your own references, you can check in SEC AF7 Financial Reporting Book 2017 edition or Descriptive Accounting IFRS Focus 21st edition. All right, so that is the end of my presentation today. Should you have questions, comments, you are free to do so. And where there's a need to raise a question, contact me. We can discuss on how best we can solve such kind of cases. Otherwise, I wish you all the best. Good luck. Bye-bye.